Welcome back to Let's Invest with the ASX. This video will cover some important characteristics of the main asset classes. We will also talk about some of the important things that investors need to consider when looking at potential investments. Let's start with cash and interest-bearing investments. Cash is highly liquid and low risk, but it doesn't offer growth or tax efficiency. However, cash management trusts can provide higher returns than traditional bank accounts. A cash management account is a non-bank cash account that offers competitive interest rates and easy withdrawal options. Interest-bearing investments are a type of financial instrument that provide investors with regular interest payments over a specified period. These investments allow investors to effectively lend money to a company or institution in exchange for an agreed-upon interest rate. Interest-bearing investments provide a steady income stream and greater yield than cash. They offer either fixed or floating rates of interest, allowing you to diversify your portfolio and reduce risk. The liquidity varies depending on the type of security and market, and the payment stream and capital gain are likely to be treated as income for tax purposes. The role of interest-bearing investments is to entitle investors to predetermined fixed or floating rates of return and repayment of a capital sum on a fixed date. They provide a stabilizing influence on overall portfolio risk and can act as temporary havens for excess cash while waiting for new investment opportunities. Examples of interest-bearing securities on the ASX include corporate bonds, floating rate notes, convertible notes, and hybrid securities. Corporate bonds offer higher rates of interest than other products of the same maturity because they are unsecured. Floating rate notes offer a return interest amount determined by market interest rates and may be perpetual. Convertible notes are securities that pay interest like bonds, but are convertible into ordinary shares at a prescribed price, specified time, or maturity. Hybrid securities pay a franked or unfranked dividend instead of interest at a fixed or resettable rate, and are considered complex by ASIC, so they should be reviewed closely. Exchange-traded Australian government bonds, also known as AGBs, were once out of reach for retail investors due to their high minimum investment. However, they are now accessible. You can find free government courses on how AGBs work on the website www.asx.com.au under Education. The value of a bond is primarily dependent on market interest rates and creditworthiness. When interest rates fall, the capital value of the bond will increase, and vice versa. This is known as the inverse yield-price relationship. Bonds usually carry a set interest rate paid at regular intervals, usually 6 months, until the bond reaches maturity, which is the date the face value of the bond is repaid. These set interest rates are called coupon rates, and they do not change once issued, but the market price of the bond can move up and down. Government bond markets are often the most liquid in a country and only face significant liquidity risks in times of financial distress. The amount originally invested in a bond is called the face value, and you may purchase a bond for more or less than its face value. The price depends on how much investors are willing to pay. For example, let's say you purchase a bond at a fixed 8% coupon rate for $100, with a maturity date set 10 years from now. If the coupon rate for new buyers falls below 8% during those 10 years, you could potentially sell the bond for more than $100 because it still carries the 8% coupon rate. However, if you hold onto the bond until maturity, you'll receive your original $100 investment plus the interest earned during the life of the bond. Changes in interest rates are the main factor in determining the value of a bond. A bond's capital value can also be affected by the credit rating that is issued to most securities and their issuers. Real estate is tangible property that requires a substantial capital investment and has the potential for variable growth. Real estate has several classifications, including residential, commercial, industrial, and retail. It may provide rental income returns and can be tax effective. There are ways to lose money in real estate, such as buying in an area that is not increasing in value due to factors such as slow employment growth, buying at inflated prices after a boom cycle, or overextending by committing to loan repayments that are too high for one's circumstances. There are three forms of property portfolio: home ownership for security, direct property investment for capital gains and income, and indirect property investment through a listed or unlisted property trust. Unlisted property trusts are managed by a fund manager who determines the portfolio and usually retains a high cash component in case of redemption. Their liquidity varies depending on market conditions. They can be a fund that invests in listed property trusts, which is useful for smaller investors seeking diversification. They may provide relatively high yield with moderate growth. Listed property trusts, also known as AREITs, are classified into retail, commercial, industrial, and CBD, and are traded on the ASX. They may provide relatively high yield, tax efficiency, and moderate growth. They are usually less volatile than other types of shares, as they are held by investors mainly for income purposes. Share market investments. Investing in shares and other share market investments has the potential to offer many benefits, such as the opportunity for capital growth and protection against inflation. In the long term, the overall high rate of return can be attractive, usually ranging from 3 to 7 years. Additionally, investing in the top 300 stocks can provide fairly liquid assets. Direct share investing may incur entry and exit brokerage costs, but there are usually no ongoing fees. Franked dividends may provide a steady, tax-effective income, and the share market is open, fair, and regulated by authorities. However, there are potential drawbacks to investing in shares. Unfranked dividends are subject to income tax at your marginal tax rate, and capital gains from share investments are subject to capital gains tax. Shares can also become completely worthless, which is a risk to keep in mind. Investing in overseas markets can produce higher growth rates than those available in Australia, and gain exposure to sectors that are poorly represented in Australia. However, there are risks such as currency fluctuations, changes in liquidity, high volatility, difficulty finding information, as well as commissions, taxes, and other costs. Historical information about companies can often be found on the company's website, which can help in making informed investment decisions. Diversifying refers to the strategy of spreading your investments across different asset classes, such as shares, property, fixed interest, and more. By diversifying your portfolio, you can potentially reduce the risk of incurring a substantial loss or receiving insufficient returns. This is because different asset classes perform differently in different market conditions. Diversification helps to balance out the ups and downs of the market, so you are less exposed to any one particular asset class. Inflation is a consideration for all asset classes. Even low inflation works against you by reducing the purchasing power of your money. Bank savings interest does not do enough to counter inflation. When inflation is low, interest rates are also low, which means that your savings will continue to lose value. As of April 2023, the current inflation rate in Australia is 7.8%. To maintain the real value of your investment, your after-tax return must be higher than the inflation rate. Therefore, it is important to consider inflation when choosing an investment strategy and diversify your investments accordingly. Thanks for watching. Click on the link for flashcards that will help to reinforce your learning. Leave a comment below, and don't forget to like and subscribe to support our channel so we can produce more valuable content. See you in the next video.